Creme Wealth Management, we come with no pretense. Financial advising, making money make sense.
Welcome. Just wanted to take today to get together with Jeffrey Brewster and talk a little bit about business valuations. So Jeffrey is a business valuation expert, works at Baker Tilly, heading up that division, and has a background also in financial planning. So we connected on more than one level. I get a lot of questions about how to value a business, ways to put together a business plan that plays to valuation strengths. So we're just going to have a conversation about that today. So how are you doing, Jeffrey?
Doing great. Thank you for the opportunity today.
Absolutely. Appreciate you taking the time. So we're just going to, get into it right away. Just asking, what would you say the basics of valuing a business are? Sometimes people talk about EBITDA, free cash flow, looking at multiples of that. Other times I hear things like, all that just adds up to basically 1 times gross revenue. Can you speak to some of those kind of water cooler conversations that typically happen in the industry?
Yeah, absolutely. And that is accurate, because so many times people want to really boil down a very complex topic, and that is business valuation into some multiples. And what it really boils down to, you go back to your first class in finance and what's something worth. It's really the present value of the future cash flows that asset is going to eventually and hopefully sooner rather than later provide to the owner of that asset. So that sometimes can be overwhelming to think about, especially if a company isn't in a cash flow positive situation. So we used to chuckle that there's always an EBITDA out there that kind of opens up the conversation, and then there's always an actual EBITDA out there that the actual transaction goes off at. So they're quite different in times, but yeah, it's very, what I would say, it's very tempting to want to go towards a simple multiple and say that's what it is, a multiple of revenue or a multiple of EBITDA or a multiple of book. But oftentimes it's a bit more intricate than that, and simply, again, summarizing it to a multiple sometimes leaves a little bit to be desired.
So they might be leaving money on the table by simplifying it, is basically what you're saying.
Absolutely. Or in the case of an acquisition, maybe not totally understanding all the characteristics and attributes of the asset that they're maybe perhaps trying to buy, the company that's trying to buy, or even a segment of a company that they're trying to buy. So it is a little bit more involved than just a simple multiple.
Awesome. So are there certain things that someone can do to kind of maximize the value of their business? A lot of the people that I'm working with are somewhere around 5 years out from looking at a liquidity event potentially, and they have a 5-year runway to say, hey, how do I get the biggest bang for my buck? Are there certain things that you say to do, to stay away from, anything like that?
Great question. And I will say that it really depends on the industry. Very specifically, if you're in an industry where high growth is the norm and your competitors or your other industry participants are growing at double-digit revenues, well then, there's got to be some consideration for that in order to be what I would consider not only a viable candidate for a possible sale, but also an attractive one to a potential acquirer or a potential buyer. And I think you can take a look at really, internal factors, and then you can also take a look at external factors. And you'll hear evaluation folks occasionally call those, the micro versus the macro. And really, we're going to talk just for a minute about internal factors. What kind of things can you look at as a business owner to say, we want to have these in order to make sure that upon a diligence or a due diligence, which will occur more than likely if you're selling to another company, that when they come in and they investigate us and they look at all of the aspects of our financials and our operations and our people and our customer list and our industry, you want to have as few negative marks in those columns as you possibly can. And in fact,
Yeah.
what you really want to do is you want to have the positive marks in, things such as, very well put together financials. Obviously the highest standard would be audit, good financial controls, understanding the reporting on a regular basis, so that someone who comes in doesn't have to implement all of these upon a transaction. So there are a myriad of things that a business owner needs to be, really thinking about in the next 5 years. And I would always say, let's concentrate on what you can control and then expand on what you can manage. And when I say what you can manage, that's what's going on outside of the four walls, so to speak, of the business. Because you can manage risk to a degree. You can look at your customer base and say, if I have a very concentrated customer base, and what I mean by that is, if you have a customer base that maybe is, 50% or more of your revenue comes from one customer, or what a lot of folks don't, take into consideration is maybe 50% or more of my revenue comes from one industry. And maybe that's maybe it's something as easy as, well, okay, I think all of these companies that are my customers are in some way, shape, or form connected to the hospitality industry. And then something happens in the economy where discretionary income declines significantly. Well, now a vast majority of my revenue is related to that industry, and perhaps a decline could occur in my revenues as a result. So, again, kind of what can I manage on the outside of my business structure? Well, in that case, maybe I need to think about being involved in an industry other than hospitality. Maybe I have to look for another industry that could utilize my services, but maybe just in a different way.
Yeah.
So,
No,
so those are things that I think, if you've got a 5-year time period to really stop and think about my runway, you have a much better chance to getting to the end of that 5 years in a position where a due diligence doesn't reveal any really, you'll hear the due diligence folks talk about the skeletons in the closet. And those maybe are more of a different ilk. But when you get to the end of that 5 years, you're in a much better position to stand in front of a due diligence, say, we've got a really solid company, and whoever buys us is really going to get a very good operating company with great financial performance.
Is there a timeline where it's almost too late, right? 5 years is a good runway. What about someone that only has 2 years?
I still think you can do things within 2 years to really prepare the business for the best opportunity to be sold. And those, obviously you don't have as many. You can probably still get an audit done within 2 years. You can still, think about succession planning. You can still think about incentive compensation plans for the key employees that are going to be very important, perhaps for the next owner. If they think that there are some key people there that really need to stick around and really need to provide great service and a high level of service until the day of that transaction. And then after that transaction closes, we can put some things in place. So 2 years is definitely enough time to be able to do that. I think I'm thinking about, diversification of the customer base can also occur within that 2 years. Maybe not completely succeeding in diversifying that customer base, but certainly you can begin the initiatives and show traction and progress in achieving certain milestones within trying to diversify that customer base. So I think within 2 years, that's a pretty good time frame. And we usually help clients in that kind of situation say, well, what's the biggest bang for your buck? Because you're going to have a number of different initiatives that you can undertake if you're thinking that you're selling the business within the next 24 months. Well, what initiatives should you take in order to get the best return on your investment of time and perhaps even capital?
Yeah, that's great. You mentioned in there employee packages, right, for key employees to keep them on board, keep them engaged. Are there any particular ones that you've seen work a little bit better or a little bit worse in that kind of situation?
Yeah, there's all kinds of employee compensation programs out there that are, I think, best customized to the entity itself. For instance, I spent a number of years valuing ESOPs, and those are very good programs for the right type of company. An ESOP will not solve all of your operational issues. In fact, it may not solve any of your operational issues.
Yeah.
But implemented in the correct manner, and you have to take into consideration the Department of Labor, ERISA, IRS. You're kind of inviting a couple more parties to the table, as I like to say. But they're fantastic programs when implemented correctly. Do you want to implement one of those 2 years before you do a transaction? Not unless that's the business owner's potential liquidity event is through an ESOP. So 2 years might be, kind of going back to your example before, might be a little too, okay, I'll just say it. In my opinion, it's too short of a time. I'm not going to beat around the bush. If somebody told me they were selling the company in 2 years and they wanted to implement an ESOP today, I'd say, let's not do an ESOP.
Are things like ESOPs, like RSUs, ISOs, all those options to transition equity, are those things that hinder a purchase by an outside, a private equity, venture capital, strategic buyer, or are those things that are making the value more appealing to them?
It's a great question, and I think it really depends on the structure, and it depends on the company, because in my experience, it's been, if those would essentially, like a restricted stock unit or some other sort of incentive compensation unit, if those vest immediately at a change of control, now you have a liquidity event that you have to take into consideration at the time of the transaction. So sometimes those can be a bit more of a challenge. At the same time, they can be exactly what is needed so that you have a good transition and a good retention of key employees through the transaction. So I think it really depends on, how the buyer is viewing the individuals that are part of that, I'll call it incentive compensation plan. So if it's your key C-suite folks that you definitely want to keep, or your folks that are on the line, or your salespeople, and you most certainly want to keep them in place throughout the transition and for certain periods of time after that, having something structured in the form of an incentive compensation program could be a very, very valuable asset through the transaction process. Again, if all of a sudden these needed to become liquid at the date of the transaction, and the buyer looks at that as a drain on cash, that could be viewed differently. So it again, Andrew, great question, but it really depends on the situation.
Sounds good. So a lot of businesses these days, it seems like, has a lot of recurring revenue, unless you're in product sales, in which case you might have more transactional revenue, but even then you have recurring orders. Does recurring revenue play into the valuation positively, or is it just purely revenue and it doesn't matter if it comes from the same source over and over?
No, recurring revenue is always viewed positively, because, well, just for the simple fact that it allows the finance team, it allows the management team to really plan better. If I told you that next year, 45% of your revenue is essentially signed up and it's coming in, versus me telling you next year 85% of your revenue is coming in, and how to plan for that. How to plan for that from a capacity standpoint, how to plan for that from a personnel standpoint, how to, again, it just makes it overall easier to plan. And obviously, recurring revenue for that reason is, I think, valued more highly in the overall transaction process than transactional revenue.
Yeah, awesome. So in what I do, I sit down with business owners. We look at the current projected valuation of whatever they think it is, whether they've had an official one or not, of their business. And then we figure out how much income they'll need, what kind of cash flow they'll need to reach their goals, either in retirement or pre-retirement, whatever that looks like. It is not uncommon to have someone say, well, I'm not going to sell my company. I'm just going to basically walk away from it, not do any of the day-to-day, have my team take care of it because they're doing most of it anyway, and just continue to receive my paycheck, receive my K-1, whatever that looks like. Does having that mentality, is that a positive mentality when it comes to valuation application, or would that provide some sort of negative implication towards a potential sale in the future?
Yeah, it really is a great question, because it happens in reality frequently. And I will say that in your example, I'm going to assume that we have a good management team in place, that the business owner has done a fantastic job of putting a transition team in place, that they have the capacity, they have the capability, they have the necessary skill set to really kind of replace that business owner who is essentially exiting the business, but maybe is going to go into chairperson emeritus status. Kind of fly in and catch the board meetings, keep a pulse on for maybe once a quarter. Obviously, keeping in close contact with what's going on, but not being involved in the day-to-day. I don't think that's a terrible situation if you're thinking about an exit strategy later on, because now, from a business owner standpoint, here's the positive in that. You've proven can manage the business while you're gone, and that makes it transferable to the next set of owners or owner. Okay, from a positive standpoint, having that transition team in place proves to the next business owner or business owners that this is a transferable business that can operate without this key person in place. Now, that's the positive for the buyer. There could be a negative for the seller, in that sellers frequently will get a portion of their income in a transaction like this from something that you might refer to as a non-compete agreement. And those situations now show that maybe perhaps that business owner won't compete, or maybe, and again, you can go back to structuring, and you'll hear me say that quite a bit, because one of the fantastic things about the current environment that we're in, as far as a legal environment, as far as a financial environment, is that structuring can really solve a lot of the questions. It can address many of the issues, and you can get to a satisfactory conclusion through proper structuring. So somebody who has some very unique situations in place, I would highly recommend that they sit down and think about not only the fact that they want to sell the business, that's established, maybe not, but perhaps more importantly, is what is the structure of the business sale attempting to achieve? Do you still want to have some rollover equity? Does the business owner still want to have some say in the board? And a structure can simply help in that process to achieve what the business owner, and hopefully someday seller, wants to achieve.
I've had a few clients that have been offered deals where they had to stay on as, some sort of employee, some sort of position to help see the transition through for a period of time, 3 years, 5 years, somewhere in that range. Is that one, I guess, is that common in your opinion? And two, kind of going back to that other point, if the person is not in the day-to-day, is that really something that would strengthen the valuation to retain that owner on for the, period of time after?
Yeah. So yes, it is common, Andrew, to have the business owner stay for some period of time after the transaction closes. Going back in history, there was a period of time where buyers in general thought differently, and they thought that it's time to make a transition. It's time to make that clean cut. So we really do need to send the business owner off into the horizon with all of our blessings and many of our congratulations and good luck on the rest of your career, life, whatever be. And then it became very apparent that there was some legacy knowledge that was riding off into the sunset with that former owner. And wouldn't it be nice to have that around? So where we're at currently is basically, yes, keeping that business owner around, that to help with the transition. And yes, in fact, you're seeing that, here I go again with structure, you're seeing that structured in the form of earnouts. In the event that, again, a business owner is thinking that the price of or the value of their business is maybe significantly different than what a buyer is willing to pay, but that buyer is willing to bridge the gap with an earnout structure, so that former owner is there helping the new company achieve the goals that former owner thought they could. And so, yeah, that can be very positive. If you have what I would, and I'm going to be a very, very loose with my terminology, an absentee business owner, that's really not helping in the overall process, that's not really, improving the overall situation of the company, but letting that team really just manage it, grow it, and continue on. There's a good possibility that the presence of that business owner on a post-transaction basis may not be as necessary. So that could be a possibility as well. And also the fact that that business owner could be the namesake of the business and kind of the face of the business, or has been the face of the business, and it's the person that everybody knows and goes to and understands that they started the business, grew the business, and have essentially been the business up until maybe the last few years. And you definitely want to have that person around, because that's still the way clients and customers view the business, as maybe that is a key person. But in actuality, they're not. But you're definitely going to want to keep that person around.
Yeah. So here, I'll take it back to maybe a more basic question. Should a company, any company, in your opinion, have a business plan? Because when I used to do business consulting, a lot of times it was with smaller, let's say 20 million and less revenue businesses. Most of them had a business plan or needed a business plan, in my opinion. But at what point do you think that becomes no longer necessary, that people shouldn't worry about it because they have other things in place, like strategy meetings to talk about, more of the marketing side of things? They have a finance department to cover that. When do you think that kind of falls off for a business, if it falls off?
Yeah, I don't know that it does. I think folks who are really thinking from a top-down approach, or from a vision, how do you cast that vision in the company? How do you essentially communicate with your leadership team where you believe the company is going? I think that really is a byproduct, and I don't mean that in a negative way or to minimize that, but I think it's just a natural extension of the business plan. And I think it's very important for people to consider that. Now, does that mean the business plan won't change? No. And in fact, I think the business plan, in my opinion, probably needs to change more often than what business owners maybe were initially envisioning it changing. So perhaps it needs to be, reviewed 2 or 3 times a year, and not just thought about in November. And maybe it needs to be revised in September based on things that happened in the spring of the year. And maybe instead of us just thinking about a business plan at the ends and the beginnings of the year, we need to think about it, right along with our 4th of July holiday. Like, okay, where are we at? How have things changed? And obviously the black swan events that we've seen over not just the most recent time period, but over decades. At different points in time, business plans have had to pivot based on unforeseen events that have consequences far beyond what we could have ever imagined. That's a time to pull the business plan out, dust it off, see how are we doing in comparison. And part of that business plan, I think, is also a strategic plan. Where do we really envision ourselves being? And let's not just, consider it this as an operational plan, but really full encompassing, professional and personal, because so often, this too, Andrew, as you sit down with business owners, it's part of their family. The business is part of the family. If you could imagine an extra plate being set at the dinner table for the business, it eats there every night and every meal.
Yeah, absolutely. Do you think that having a business plan impacts valuation positively, directly, not just indirectly because you're doing things right and you've got, these goals set and everything?
Yeah, I think it does. If you actually are using that business plan and updating it and moderating it and really taking the business and taking the plan and comparing them to one another and showing that this is a living, breathing document. It's not just something that we put on our shelf and paid somebody to do one time. Or took the time from our, brightest and best within the company and did it one time. And do we know when was the last time that was looked at or adjusted or modified based on the current. We don't. That's not going to be a situation where I think it helps the valuation of the business. I will say that a business plan that also includes a forecast and some strategy thinking from that standpoint is a very valuable, and I should say value added piece to the business, because it gives the impression that the team is thinking in a more corporate way and not just simply thinking about it from a reactionary standpoint. And I guess it elevates the level of, or elevates the impression of the company and to the potential buyer. If you pull out a business plan and you say, well, this is what we have as a business plan. Here's our financial forecast. And whether you hit that forecast, exceeded it amazingly, or missed it, the fact that that's in place, I think, is going to be helpful and a value add in the overall business.
Awesome. Are there any, I guess, who are the usual suspects when people think of an acquisition? Private equity, venture capital, right? Strategic, internal transactions. And the other piece of this question is, do you typically see higher valuations applied to certain of those more than others?
Okay, so that's a big question. Let's unpack that. So the typical buyer, especially in the last 3 to 5 years, has had some kind of private equity backing. That's been typical. I have been involved in transactions and helping close some transactions that just in the last year that were competitors or suppliers, essentially, that wanted to, again, in one case wanted to expand into a different geographic market, and in another case wanted to expand into the supply chain. Both of those had, one of those actually had private equity backing, one of them didn't. A number of the transactions that are occurring today, however, and certainly in the last, like I said, 3 to 5 years, have had some kind of private equity backing. And I will say primarily because the amount of capital that is available to the private equity, in the private equity space, is really at historic levels. As of 12/31/2019, there were some estimates out there that there was $1 trillion of dry powder available to private equity funds. So you have a tremendous amount of capital looking for a home in good companies. And what that really represented was a very, very strong transaction environment. And that played through, and I think will pick back up again.
So private equity being one part of it, does venture capital fall in a different category, in your opinion, from that?
Yes, it does. Venture capital, in the valuation community and the finance minds out there, you kind of start thinking about the risk-return relationship. And that venture capital thought process is that, yes, we're taking a much bigger risk earlier in these companies for what venture capitalists hope for a higher return, and a significantly higher return than later investors in the company. So I think private equity folks probably are coming in, they are coming in after venture capitalists.
So venture capital is more pre-revenue, would you say, or beginning stages?
Yeah, I would say early stage companies, not necessarily always pre-revenue, sometimes just pre-cash flow, sometimes just pre-earnings. But yeah, there's certainly a number of cases where venture capitalists will come in even on a pre-revenue basis. we've done some valuations. I've worked with some folks who in fact have invested on really a business plan. We call them the white paper venture capitalists, where they essentially just look at an idea and they say, yeah, we want in on this soon.
And for that, they want basically a better deal. And I'd imagine they want a higher percent of ownership.
It depends. So, sometimes they do. Sometimes I would say that most of the time, venture capitalists are going to want to have a control position. That's a real key piece here, is that there are a handful and a growing number of PE or private equity groups that will take minority positions in companies. 5 years ago, those were very hard to find. But now those are becoming more prevalent in the space. And obviously, for reasons that are numerous, when you have control, a private equity group or a venture capital group has control. Now that becomes a different dynamic for that business owner.
Right. So one of the gripes I've heard from people about private equity, for example, is that they feel an attachment to their businesses, as we talked about, as you mentioned, and the employees. And sometimes there's even family members that may be employed that they have concerns for. And it is not unknown that private equity is very much about reducing costs, maximizing profits, and in some cases, looking to even flip that business a few years later and resell it at a higher valuation. I guess, what's your thoughts on that? For someone who has a business, they care about their employees. They didn't just do it to make a buck. And they are concerned about, well, if I sell half of my staff, any redundant position to the acquiring entity is going to be, immediately terminated. How do I protect my business and my family and my staff from this kind of thing happening?
Right. So what you just described, Andrew, is probably more what I would consider the legacy thought process. Do I want I'll just, for simplicity, take two roads here. One road would be, I really want to maximize the value of my business in a liquidity event where I sell and I really monetize and I stick around. I work as much as the private equity group wants me to be around. And maybe later on, I'm not as concerned about whether my name's on the wall, whether my name's on the side of the building. And maybe I'm just at a point in time where a majority of my workforce will probably retire in a few short years. And maybe I don't need to really think about the legacy of the company. There's a few companies that come to mind that are like that, where they understand that one of the reasons that they are talking to a private equity group is because they can bring this infusion of that mid-tier talent that maybe that business owner wasn't attracting into that company throughout the time that they owned it. So the proper step would be, yes, selling to a private equity group, and those people who are around, yeah, they're probably going to retire or choose to do something different. That would be a great way to think about that. Now, another road would be the legacy road, where I walk through the halls of the office and I know those people, and I've been to the kids' birthday parties, and we go to graduations, and they come over to my house for picnics, and for me to think about them retiring in the next 5 years, I couldn't have ever imagined them doing that. And I'm really concerned because I know that vast majority of my employees have responsibilities that are going to go on for the next 20 years. Well,
Right.
Okay, that's a different road, and that's a different way of thinking. And in those cases, when I've sat down with clients and that has been explained to me by the owner, we start thinking about business transition into the group of leaders and trying to identify the next group that could be coming up that would take over the business, and that legacy is maintained. Again, I go back to structure, Andrew. There's a way to structure transactions to achieve what the business owner is looking for. And really, one of the things that I think we bring to the table a lot of times for clients is just sitting down and going, okay, tell us what you like to do.
Right.
And just listen, because the business owner will give you the road that they're on.
So let's say someone's on that legacy road, you've identified it. What are some of those, equity transition vehicles that you've seen the most success with from your perspective, that accomplish that for them? Yeah.
So one that I just actually talked about with somebody today is a stock appreciation right. So essentially, they had given stock appreciation rights a few years ago. You'll also hear these called SARs. And essentially, the business has done phenomenal over the last 4 or 5 years. So the value of that stock appreciation right has, as the name implies, appreciated. Success, right? Things have worked. So now, as this business owner is transitioning out, that person is going to be able to utilize their stock appreciation rights as a down payment, so to speak, for the company, and then buy out a portion of that company thereafter, utilizing the cash flow from the business, their portion of the cash flow from the business. So, Andrew, I see that works very well. Some groups actually do a great job of going out and raising capital themselves and saying to the business owner, we're going to buy you out over time. And she might be very happy about getting something over 5 years, because that's exactly the window that she has before she wants to go out and do something different with her life. And it's very interesting when you get to see that, because now that business owner has the opportunity to transition, leave their fingerprint, so to speak, on that business where they think it should be, and then essentially back out of places where she thinks someone else should take the leadership role, because again, that's part of growing up and managing that business. So I've seen those work really well. You always want to take into consideration tax impact. And that's where again, talking with the business owner this morning, I said, you really need to take into consideration not only your tax impact, but the tax impact of the employees, your soon-to-be partners, of how this will impact them overall. Some companies have an approach of, we want to take care of that. Others have an approach of, that's part of owning a business. You need to take care of that yourself. And again, it all comes back to structure.
Yeah. Awesome. So if people are in these kinds of situations, what are kind of the linchpin events that should make them say, you know what, now's probably a good time for me to reach out and set up an appointment, set up a time to talk, and understand the valuation side a little bit more in my business?
Well, the clear situation that we have right now is this opportunity to do some transactions from a tax standpoint. At any point in time along the line, along the continuum, that a business owner is provided with an opportunity to structure a transaction, that's fantastic. But maybe in the interim, they want to transfer and get that wealth over from a tax planning strategy, from an estate tax planning strategy. They want to get that into a different vehicle that's more tax efficient, or do a tax efficient transfer. That is always, again, today, I would say is a very good opportunity to be thinking about that. The minute that a business owner starts thinking about the exit, I think it's then that they need to start talking to people about what that exit could look like. And that exit conversation can be quarterly, monthly, and the cadence of those conversations are going to increase as that business owner gets closer to exit. Right now, we were having conversations with business owners on about a monthly basis, and that cadence has slowed a bit because it looks like the transaction is going to be further away. And when I say we, I would say that business owner needs to be talking to their advisors in that thought process of how often am I thinking about this exit? If it's within 3 years, you should probably be having a monthly conversation with your advisors about where this thought and conversation could potentially go up to that liquidity event. The closer that liquidity event gets, the closer that exit date gets for that business owner, sometimes those need to happen. Those conversations with your advisors may need to happen as often as a weekly basis, just to say, where are we going? So the short answer to that, Andrew, is as soon as that business owner starts thinking about an exit, they need to start talking to their advisors about what that exit could potentially look like.
So we use the term advisors fairly loosely, right, in finance, right, being a financial advisor, business advisor. The business owners I've talked to kind of lump a certain category possibly in that as well, which is business brokers. What are your thoughts on the right time, if any, to be approaching them as a business owner? Because I know a lot of business brokers are a little bit more aggressive on their reaching out and being connected, and a lot of business owners might turn to them because they just dropped off their card. Yeah, I'm thinking about selling. Kind of give the pros and cons of that, because I think it's an area that people don't talk about as much.
Right. Business brokers definitely provide business owners who are in that position to selling the company, they provide them a great service. Like you mentioned, the connections, the urgency at which the business broker works on, because typically a business broker is going to be on a commission basis. They need to close the sale in order to monetize, make money, feed their families. And so they are going to be very incented to get that transaction closed. I would say that if a business owner has a handful of potential ideas as to how the business could be sold or who it could be sold to, a business broker may not be necessary in that case. You can make a case for it if you're going to try and sell to your competitor. The last thing you want your competitor to know is that you're thinking about selling, right? And maybe a business broker at that time makes more sense. However, if you're thinking about the fact that you'd like to transition it to 4 or 5 people within your company, I don't think a business broker is going to help in that situation, unless you're trying to figure out what would another potential buyer pay for this. You can also get that through folks like myself, business valuation professionals, who could come in and help you with that and step back and say, here's what we anticipate you would be able to get. And then you can transact at that with your key people in your company. So it really depends upon the situation. I would say if you're looking at really trying to sell the business within 12 months and you're really not that concerned about a legacy necessarily, business brokers would probably be a good idea to think about. On the other hand, if you're looking about structuring it and considering a different kind of a legacy that you want to leave with your employees in the space, in the industry, it would take more advisors from a standpoint of tax planning, folks like myself in the business evaluation and consulting area, and people like you as well, Andrew, that say, what does this look like? What do I really need at the end of this exit strategy to live the life after the sale of the business that I'm hoping for?
Right. Absolutely. And how does that play into that transition?
Absolutely.
Yeah. Awesome. Well, I appreciate your time today, Jeffrey. Thank you for all the information. We'll definitely get a link up on this video with your information so anyone can reach out to you directly to find out more.
Thank you, Andrew. And like I always said to you, and I've always said to my clients, we basically love thinking about things at 2 a.m. that are keeping you up at 3 a.m. And that's what we do.
Awesome. Well, great. Thanks.
Thank you.